Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hey everybody, welcome to the podcast. I'm super excited for today's podcast because we're talking about one of the most interesting parts of the US tax code, and I think one of the most misunderstood. And my guest today, I think, just had an article published about why CPAs need to take this area a little bit more seriously. We'll talk about that here in a minute, but it's the dreaded PFIC rules. And when I say PFIC, just for the audience, the acronym PFIC, Passive Foreign Investment Company Holding Rules. And so we're going to get into, what is a PFIC? Why is it bad? How can you deal with it? In our world at the Wolf Group, we refer to PFICs as tax kryptonite. So, you're Superman, you're Superwoman, you're flying along, and then you somehow meander into the PFIC rules, and it's like kryptonite. It just kind of drags you down. And so, what are some things to think about with that? How do you deal with it? How do you get around it? And my guest today, welcome, Mary Beth.
Thank you, Mishkin.
Yeah, so Mary Beth is, in my opinion, a super expert, or the expert, if you will, on PFICs, all things PFIC related. I've known Mary Beth for a very, very long time. She and I are kind of on the same lecture circuit as far as giving presentations and talking to, trying to train up CPAs and different members of the tax profession in this area. So, a lot of times if there are questions or issues, I'll either go to Mary Beth directly or go to one of her very informative articles that she kind of tends to publish here and there on a variety of different tax topics related to PFICs. But before we get into that, Mary Beth, give our audience a little bit of background about yourself, kind of your certifications, kind of what you're doing right now, where you're at with everything, all that jazz.
Sure. So I'm an enrolled agent. I'm also a tax court practitioner, U.S. tax court practitioner. There's not a lot of us doing that. I have a specialty in international taxation and tax controversy. Here's where I'm going to date myself. I started working in tax in 1978.
Wow.
Yeah, I know. But I've been doing exclusively international since the early 2000s when my husband and I moved to Canada for work. Fortunately, as I'm learning this back in the early 2000s, it was before the IRS started imposing all those huge penalties all the time.
Mm-hmm.
So I was very fortunate to be able to, learn my skill and that without the same risk that's out there today. When my husband and I came back from Canada, I started a U.S.-Canada cross-border tax firm, which I sold last year. So I'm very happy about that.
Yeah.
One of the lucky byproducts, though, of that particular endeavor was that I partnered with George, a very talented programmer up in Canada. He wrote the PFIC Form 8621 calculator software. And since then, our company, Expat Tax Tools, has, I believe, become the established leader in PFIC taxation, Form 8621 preparation, training. We work for both practitioners and the do-it-yourself for both taxpayers. Since I sold my firm, I'm spending a lot more time over at Expat Tax Tools, and we are expanding our products this year, so I'm really excited for that. We're going to be, we do international, very niche software. We have a global gains calculator that's just now being released that will convert brokerage statements or investment transactions from any country's rules to any other country's rules.
Wow.
So we're really excited for that. So you can take something with an odd tax year like the UK, feed it into our stuff, and it'll spit it out on a calendar year, spot rate conversions, first in, first out, wash sales, all set to go into the U.S. Schedule D, or vice versa. We're also doing it. We have a 962 election assistant, so I'm excited for that. We have a whole lot of new stuff.
Does any of that stuff relate to crypto?
No. We did do some crypto early on. We were working on a crypto calculator, but trying to get the spot rates by the minute was just impossible.
Okay.
So, and then a lot of other firms had stepped up and filled that space. So no crypto, but if you have crypto statements in other countries, you can certainly run them through our global gains calculator and convert them to US standards, or from US standards to any other country.
That's fantastic. So a little background for the audience here. Believe it or not, and I like to think that we pay the biggest price for the best tax software, being CCH Access. But and no offense to CCH or any other tax software out there, but they're modules for whether it's PFICs or like Mary Beth said, getting foreign statements. They're just not that great. And I've been asking for years, like, can I get a module that's just dedicated to like a streamlined filing submission where I can do 3 years, and a lot of people don't realize how clunky it is and how much time you have to spend, just doing because again, you do the first year and you got to make sure that that's correct because it rolls over to the second year. And if something's wrong back in the first year, then you got to go back and fix it and then roll it into a brand new version. And it's not, I think a lot of people clients can't conceptualize or visualize, the amount of work that goes into some of these things, which if we just had better software, like what Expat Tax Tools is probably doing, it probably would be more efficient, less costly, all the way on down the line. So very cool to hear that you're kind of leading the forefront and the charge on that. I'm a big fan. Let's dovetail back though to our discussion today on PFICs, because I really want to make sure we're giving the audience, the customer, what they're looking for here. Okay, sure. So tell us, what is a PFIC talk to me like I'm a third grader. Actually, my son's a third grader and he's about to be a fourth grader. So talk to me like I'm my son. And he's like, Daddy, I don't understand. What is a PFIC? Tell me what a PFIC is.
Okay. So as you said before, the acronym PFIC is Passive Foreign Investment Company. So essentially what these are non-US corporations that either hold a high percentage of their assets for the production of passive income, or a high percentage of their income is passive income.
Okay.
They came into being, we've had them since the Tax Reform Act of 1986. So PFICs did not exist before January 1 of 1987. So they've been around for a while. The taxation is punitive. It's meant to be punitive. It's, if you think about it, back in the day, back in the 80s, we weren't a globally mobile society the way we are now. Mm-hmm. So these rules were really geared to the wealthy people that could, afford to have, sophisticated setups for their tax planning, right? So they could invest overseas and they could have these foreign corporate structures that would essentially go tax-free, right? Tax deferred and potentially tax-free at the end. So they haven't changed the rules since then, because now there's a lot of people that are coming into the United States to work. And they come in with their PFIC investments. And there's a lot of Americans living outside the United States that, again, they have PFIC investments. It's just, the way of the world now. But PFIC rules haven't changed in 40 years.
Let's talk about some common examples that you see. So if I think of common examples on my end, it would be someone comes to me and says, Mish, I've got a stocks and shares ISA in the UK, or I've got investment brokerage accounts or life insurance in India, or something like that. Give me some examples of things that our audience should be aware of that would key them into what is a PFIC.
Okay, so the PFIC is not the account. So it's not the ISA account. It's not the life insurance wrapper. It's not the Canadian TFSA account. But inside of that, you can have PFICs. PFICs, the most common ones we see are mutual funds, exchange traded funds, and real estate investment trust, or REITs, that are formed outside the United States. So think about the normal brokerage accounts that people get outside the US when they're saving for their future, Or heaven forbid, what about those foreign retirement accounts?
Yeah. Ooh.
Without the typical investment in a retirement account, you get a whole list of mutual funds you can choose from. Well, when they're not US, they're PFICs. There is a carve out for certain plans in certain countries, and it's got to do with tax treaties and that. But heaven forbid you've got an account that doesn't fall under one of these exceptions. Yeah, you probably have PFICs.
Now I'm going to play devil's advocate here for a second. I'm going to throw a Phil Hodgson curveball at you. You said real estate investment trusts. Mm-hmm. If a client comes back to me and says, "Well, Mish, that's a trust. That's not a corporation. Why would that be a PFIC?" And what would your response be there?
Well, you have to go back to how the Internal Revenue Code looks at this, right? So the IRS doesn't care what the other country calls it. Just don't care.
Okay.
But when you have a trust that is set up for profit, for investment and that, it's going to turn into an association under the Internal Revenue Code rules, and thus it becomes a foreign corporation. So you have to look at how would the IRS categorize this particular investment, because we do hear that a lot. It's like, oh, in Canada, they set them up as unit trusts. Well, you have to go, don't care what Canada calls it, you have to go to the code. What's the IRS going to call this?
Right. I've seen that in practice in Mexico, they have the fideicomiso, which a lot of people in their head are like, oh, that's a grantor trust. But, I think when you do the analysis, in some cases, it could be a foreign, a business trust classified as a foreign corp or a controlled foreign corporation, or to some extent could be a PFIC, depending on levels of ownership and interest in that. So,
absolutely.
Okay. Talk to me about the statutory test, just so that people, and you don't got to go into deep. I'm not asking you to go Uncle Scrooge diving into the bin of all of his gold. Just give me the top level, like what's the statutory test and why is it important?
Sure, there's two different tests, and you only have to meet one test to be a PFIC. The first one is the income test. You look to see if 75% or more of the foreign corporation's income is passive income.
Yep.
And passive income is defined in the code. It's 954C, just what you think it is. It's interest, dividends, rents, royalties, foreign currency gain, that type of stuff. The other one is the asset test. And that's where 50% or more of the foreign corporation's assets are held for the production of passive income. Mm. Now, keep in mind that cash is a passive asset. And you can run into trouble even when you have an active business. If their working capital account, they're required to keep very high working capital, that can push them up into PFIC status, even if they're otherwise an active business.
And we saw that a lot during COVID, right? A lot of companies, a lot of foreign corps ended up stashing cash during COVID, and then that would change them from being an operating company to a PFIC. And sometimes I think we have the weird overlap rule, right, where you have both the CFC and a PFIC, and that can create an odd result when you have something, a weird turn of events that occur like that.
Absolutely. And not only that, you have to do the look-through rules. If they own other companies, do they own a certain percentage of it? Do we look through to see what the other companies own? It can be really daunting to figure out whether or not something really is a PFIC or not. It's not always easy.
Okay. What would you say if a client came to you and said, well, wow, this is crazy. What's the purpose of these rules? Like back in 86 or before it came law in 87, what was the thinking behind why these rules came into play? Like, were a lot of people holding foreign, was this more for closely held companies that people were holding minority stakes in, or was it really, the combination of Wall Street and the U.S. mutual fund industry not wanting people to meander outside and kind of push everything through them? What's the purpose here, in your opinion?
Wait, one thing, I don't know if the U.S. mutual fund companies ever had anything to do with it. From my research and talking to people, it was, again, back in the day, wealthy people could have these foreign corporate structures and they could drop their investments in there. And under the rules at that time, unless it was a CFC, a controlled foreign corporation, IRS couldn't tax it until the money came out. So they could it'd be like a Roth IRA. It would just grow tax deferred, forever. And These rules came into play to level the playing field to take away that benefit of tax deferral that a lot of these people were doing. Again, it was not as common then to have regular Americans owning these types of investments, because we weren't globally mobile. We weren't, people weren't as international as they are now. And, so it's become a bigger and bigger problem as we get people coming into the US and become US tax residents, or we have Americans that are going overseas to work. But basically it's to level the playing field for people that were investing in the United States and playing under the US rules.
Got it. And what forms do you generally need to fill out if someone says, "Hey, I got a PFIC, Mary Beth, what do I got to do? Like what do I need to complete?"
So you need to do Form 8621. There's a very small de minimis exception to having to file the form. I'm not going to really go into that unless you really want to. But most people, you need to file one Form 8621 for each PFIC that you own. So if you have 5 mutual funds in your UK ISA account, you need 5 8621s, and you need to file it every year. In addition, these investments, would probably also need to be reported on a Form 8938 if they meet the threshold, and certainly FBAR. So you can run into trouble if you miss some of those ancillary forms. But Form 8621 is the one that's required.
Okay, so now let's do a hypothetical. I'm a client. I've come to you. I purchased a PFIC, and it's my first year that I have it. I come to you, and you inform me, "Hey, Mish, you got tax kryptonite. It's going to have to be reported on your tax return." And what are my options? And specifically, I'd like to just talk about the QEF mark to market, and then any other commentary you may have there. What doors can I walk through?
Well, so the good news is the IRS gives us options with PFICs. And I think we need to kind of, at a high level, discuss what the default, the 1291 treatment looks like if you don't make the QEF or the mark-to-market election, right? So the default treatment is that only realized income is taxed. So you don't have any obligation to pay any tax until you actually realize income, whether it is as a distribution, you receive a dividend, or you sell something. When you do that, any gain is allocated over the entire holding period. They assume you've earned it equally per day over the entire holding period. So they don't care if it had a spike one year and went down another. Gain equally is allocated over the entire holding period. Anything that is allocated to the current tax year and any year it was not a PFIC, so perhaps they came into the United States, it became a PFIC the day they became a US tax resident. So any periods before it was a PFIC and the current year are ordinary income. Just goes on your tax return as ordinary income. Any of those other years, the IRS will tax that money. It doesn't go in taxable income. They calculate a tax at the highest rate for that year. So for individuals, for the last few years, it's been 37%. Before that, we had 39.6%, we had 35%, whatever that year was.
Right.
But in addition to that high tax, the IRS is going to incur interest or assess interest as if you should have paid the tax in the year it was assessed. So, for example, you had $10,000 of income allocated to, say, 2016. The IRS is going to say, okay, well, top tax rate was 39.6%. Your tax is $3,960. And by the way, we're going to assess interest from April 16, 2017 to the due date of this current tax return. Ooh. So as you can see, the interest could be quite onerous, and it can get real nasty real quick.
That would drive up your tax rate. I mean, if you think of your effective tax rate on that particular PFIC, that could be what, 45, 55, 65%? I mean, it could go pretty high.
It could be pretty high, and especially if they owned it for a lot of years. If they had it for 30 years in the United States, you could end up paying more than they actually earned in the investment.
Oof.
So it can be pretty nasty. If you catch it in the first couple of years, it's usually not too bad.
Okay.
So the IRS gives us choices, like I said. So the other choices are for you to pay tax currently. So each year there's an assumed tax. How much income would you have had on this investment? The first is the qualified electing fund, or QEF election. This is the one that most closely mirrors how the U.S. taxes U.S. mutual funds. It allows you to include in your income every year the estimated amount of income had the mutual fund distributed its income to its shareholders. So it will give you a PFIC statement from the mutual fund company or the PFIC that tells you the amount of ordinary income and capital gains to include on your tax return every year. If you receive distributions or dividends, you don't include those on your tax return. Your basis of the investment is going to go up and down. It will increase by income included on your tax return. It will decrease by any distributions received. So when you finally sell it, it is given capital gains treatment. It's the only one of the elections that will give you capital gains treatment.
Right.
Mark to market, it's a little different. Not every PFIC company will produce a PFIC statement. You have to have that statement to be able to make a QEF election. So for those that do not provide the statement, as long as it's marketable, and again, that's a whole definition, but as long as it's marketable, the IRS will allow you to do a deemed sale or a pretend sale every year on the last day of the tax year. So again, for individuals, that's December 31. You would pretend you sold it for fair market value. And if it went up in value during the year, that would be ordinary income on your tax return. If it went down in value, you could take the loss, but only to the extent you've previously included gain on your return. The basis of the asset would go up and down. Again, it would increase by income on the return. It would go down by any loss allowed on the return. When you finally sell it, it's just ordinary income. There's no capital gains treatment allowed for that.
That's rough. Okay. And so what happens if you miss those elections? Like, let's just say I've held those for 2, 3, 4 years and that I wasn't able to make, because you make those elections, QEF, mark to market, right, in the first year. I've missed those 2 doors. I'm locked out now. We'll talk about private letter rulings and kind of some other things to do, but what do you tell people to do if they've missed it and they're locked into 1291? And obviously there may be some other cleanup items that they got to do. So there could be, streamlined filing, but what's your approach?
Well, so the good news is that you can make these elections in a year that's not the first year you've owned the investment or the first year you've become a U.S. person. For mark to market, you have to do a purging election. And basically that means you do a pretend sale. Mm-hmm. Any of the gain is going to be taxed under 1291. So you clean up that back appreciation in the investment. And then moving forward, you just do that pretend sale on December 31 every year. And then you're good to go. For QEF, you can also do election in other than the first year. But you would have the choice whether or not to do a purging election. If you did the purging election and you cleaned everything up, then when it's sold, it would be capital gains. If you did not do the purging election, when you sell it, any gain's going to fall back under the default 1291 rules.
Okay, so it may be to your benefit then to do this purging election, and we're obviously not talking about the movie The Purge here. Talk to us about the purging election. Like exactly what are the mechanics of that? So is that done on the 8621 form? Is the whole ball of wax for the purging election and then the re-election of the QEF or MTM done on the same form, same time?
Everything is done on the same form, same time. But for those of you familiar with the form, you'll know the math is not on the form. There's lines there to put numbers, but the math is not done on the forms because there's a whole set of layered allocations and it gets pretty hairy sometimes. But as far as the purging election, I would tell people, don't do it until you've run the numbers, until you understand what the math is going to be. If there's ways, there's strategies, right? So do you expect that whatever industry this is invested in, do you think it's going to do good or do you think it's going to be in a slump? So would the investment go up or down in value? What about the foreign exchange rate? If you think that the US dollar is going to get stronger or weaker, that can affect how much, gain you have in that investment at that time, right? So you're going to want to watch those. I know some of the tax practitioners will tell people as soon as they come in the door with PFICs, sell them. Just get rid of them and sell them and do away with them. That's not the best idea. I think the person needs to run the numbers and understand what the tax consequence is going to be before they make that kind of a decision and get hit with a really big tax bill. You know, there's ways to manage, you know, the exit from the PFICs and that. We usually recommend the purging elections, but we always run the numbers ahead of time and let the person know what this is going to look like.
Yeah, I think that's a common strategy for, you know, also in the CFC kind of realm, you know, that could be a common strategy for how you deal with guilty. Now that's going to be what I think they call that necktie going into 2026. But, you know, it's a common strategy to run the numbers under different scenarios and then present that to the client and say, okay, well, if you did it this way, this is what it would be. And if you did it that way, that's what it would be. My question to you, Mary Beth, though, as a practitioner, you know, you can run these different scenarios and present the information to the client. But, you know, will clients understand kind of, I mean, if I'm a client and I'm paying, you know, your fee to run the scenarios and you're giving me the outcome, and then they're like, well, wait a minute, you're just kind of giving me the outcome, but I'd love this. And I want to see kind of the mechanics of how this works. Is there a way that you think you can present that to them, given the fact that it's not this transparent form that plays it all out on there, and there's these subline, like you said, layers of you know, sub calculations that are going on where they can actually understand it? I mean, is there a way to give a client a deliverable that they can understand for these types of calculations?
Boy, that's a really good question. So it depends on the client, right? Some are more sophisticated than others. Some people, you know, it's almost impossible to explain these like you're five. You know, it really is. Our software produces calculation statements that we can actually give the clients that show all the calculations, all the allocation, all of the apportionments that are going on. It shows, you know, the currency conversions. That will help clients that really, really want to understand it. But I think a lot of it is just really understanding the PFIC rules and being able to break it down for the client. You know, I've kind of got my cadence after this many years that I can usually go through and say, here's what it's going to look like if you QEF, and here's why. Here's what it's going to look like if you mark to market, here's why. Here's what it's going to look like if you don't do anything, and here's why. So there's no real bright line, or I just don't think there's a simple way to really explain these to the non-professionals.
Yeah. I mean, I've seen some really nifty tables for, say, CFC and guilty and 962 and comparing the different outcomes. I've seen people, I think Phil Hodgson put one together that was really nice.
Oh,
but
yeah.
I've never, outside of what your software produces, I still don't have it's very difficult. And I prepare clients all the time. I'm like, it's very difficult not only to explain this, but then when we're delivering the items to you and you're trying to make sense of it, it's going to be difficult to wrap your head around it because of the way that it's presented. So just fair warning to anyone out there dealing with this and trying to really, like, you know, hey, is this done the right way? Do I understand what's happening here? That can be a tough go. Talk to me about private letter rulings, PLRs. When would you implement those? How do those mechanically work? I had Josh Smeltzer on here. He was telling me all the ins and outs for how he generally does a PLR ruling, but so you don't need to go into the nuts and bolts of what PLRs are. But when do you implement those for PFICs?
So I don't prepare private letter rulings, but I can talk to people about when they might be appropriate, right? So first of all, you have to have at least a decent amount of tax at stake here, because private letter rulings can be very expensive. You have to pay the user fee to the IRS. You have to pay, you know, your attorney or your CPA or your practitioner, whatever their fees are to prepare the private letter ruling. So right off the bat, you're into it for thousands of dollars. So you need to have, you know, a significant amount of tax that's at stake to make this worthwhile doing. So, you know, there's two different provisions to be able to do the late or retroactive QEF election. To be able to do that and do it through a private letter ruling, you need to have reasonably relied on a qualified tax professional, and they failed to identify it. They failed to tell you that you could make this election. You know, basically your tax professional kind of failed you in that respect. But in addition to that, you also need to prove to the government that they're not being prejudiced by you being allowed to make a late election. And that's where a lot of these are going to fail, right? So the U.S. government is going to be prejudiced, and this is in a revenue procedure that they just released in January, that they're going to be prejudiced if granting relief would result in the PFIC shareholder having a lower tax liability, taking into account all of the changes in the aggregate for all the years affected by the retroactive QEF election. So they're going to go back and they're going to do the calculations. And if your taxpayer is saving money, well, the IRS is going to consider the government to be prejudiced, and they're not going to allow the election. Keep in mind, they also take into account the time value of money when they do these particular calculations. So you need to make sure that you can prove that point, that the government's not going to be prejudiced. And people are going to have, I think, a hard time with that one. They'll rely on the PFIC annual information statements, and they'll run their own numbers. So it's not something that we routinely, identify as being an avenue people want to take, because it is very expensive. It's not a guarantee. And you do have to offer up affidavits and proof, and your tax professional has to throw themselves under the IRS bus and say, I missed it, I failed. People won't do that, right? So.
And I think the other side of the coin is being us, Mary Beth, which is if they do get that favorable relief, we've had this happen a couple times. It's random whenever it comes through, and then they give you a deadline to submit all the returns with the QEF election. We had one that came through, I think it came through in like late February, and they were like, submit by April 12th. And I'm like, what?
Realize it's tax season.
Yeah, it's right in the middle of tax season. And I'm like, why would you do that? It's almost like Mission Impossible at that point in time. It can be, and if you don't do it by that time, you just paid all that money, and you're not getting the relief that you need. So we've had a couple that have come through like that. Talk to me about the other, and maybe I'm missing all the options here. So you tell me if there's an additional option you want to talk about. But in some cases, and I'm not talking about stock or ETFs or mutual funds. I'm talking about closely held minority shareholding companies. In some cases, some folks recommend check the box elections, right? We take it out of the corporate rules and put it into the partnership rules. When would you do that? How would you analyze that? When would that be appropriate to do a check the box?
So great point. So automatically, if you happen to have a CFC, a controlled foreign corporation, and the shareholder is a U.S. shareholder, right, 10% or more by vote or by value, they don't fall under the PFIC rules. Those shareholders are going to be subject to subpart F. Right. So no issues there. However, where you have the U.S. shareholders that are less than 10%, they're not U.S. shareholders, these can be PFICs for them. So to make the check the box election, you have to have the consent of all the shareholders. And I believe it has to be made by the majority shareholder, but everybody has to sign off. So it's not just analyzing how it's going to affect your client, right, how it's going to affect everybody else. Because once you make it for one, it's made for all. And again, it becomes a partnership. However, I mean, this works pretty good with, GILTI and getting everything to flow through so you can get the foreign tax credits to come through. I think they're a great idea where you can make it work for everybody. Everybody has to be on board with it.
Okay. And then you just recently had, I thought it was an interesting article. Was it the CPA Practice Advisor? I forget the name of the publication. Yep. And we should definitely try to link that into the show notes. Tell us about the article that you just put out, though. It was fascinating.
So it was a little bit of a warning about, what happens when you miss filing the Form 8621 for PFICs, right? Because a lot of people miss them, or a lot of people just go, this is too complicated and I'm not going to do this, right? I don't have any income anyways. But when you're required to file Form 8621 and you miss it, the statute of limitations for the assessment of tax remains open on the entire tax return indefinitely. So the IRS could come back and assess tax not only on the PFICs, but on anything else on your tax return. So this is one of those situations where, it might not be a problem until it's a problem. But when it becomes a problem, it's going to be a very big problem. And the IRS would be able to open up your client's tax returns as far back as they wanted, because the statute never ran on them. So you want to make sure you're covering off when they're required, which is pretty much every year. Each PFIC has to file one. You want to make sure they're filed. So here's an interesting point, Michigan. Even if you don't need to file a tax return, you're required to file Form 8621. They get mailed separately to Ogden, Utah.
Oh,
So
I did not know that.
even if you don't need a return, they are required to be filed.
And I would assume though that if there were tax, say under 1291 or anything, I mean, you'd have to then do the return too, right?
Oh yeah, if there is an excess distribution that's going to create a tax, absolutely you need to file. Absolutely.
Yeah. And for our audience, do you want to explain where that tax is reported? Because I think a lot of people don't understand, the page 2, what is it? The page 2, I forget what line item it goes into, and then you have
it goes into the tax line. Yep.
Yeah, you have to mark the box. And I think you have to put accumulation distribution, or no, it's excess distribution. Sorry, that's
1291.
Yeah, 1291. So it's a really weird side calculation, right?
It is, and it's going to create issues with your state tax return as well. So if you, as I said before, the gain gets allocated over the entire holding period. So anything that's allocated to a year before it was a PFIC, or anything allocated to the current tax year, it's ordinary income. Just popped right onto the Sched 1 line 8Z, the formerly known as 21 other income, right?
Yep. Mm-hmm.
That's where it goes, and that's all good. Anything that's allocated to a prior PFIC year, any year it was a PFIC other than the current tax year, gets taxed at the highest rate. You don't put the income on the return, never appears on the return. Instead, you do that tax calculation where you create the 37% tax, 39.6, whatever the highest tax rate was for the year of allocation. That tax gets added to your regular tax liability. This year, I think it's line 16. You tick the little box and you have a marginal notation of 1291. Then you do the interest calculation, which goes on Sched 2. I think it's Sched 2. There's actually a line for PFIC interest this year.
Right. Yeah.
And you put the interest there. The interest used to be at the bottom of Form 11 or Form 8621, the bottom of the 1040 page 1. It's not there anymore. Now they actually gave it a line on, I think it's Sched 2. So all that gets added in. Now think about this on your state tax return. What happens to all that missing income? Does the state now have an add back for that? Or do they not? Right? And how does the state treat PFICs? California just tells you right off the bat, they do not acknowledge federal code sections 1291 to 1298. They don't acknowledge it. So you treat PFICs as just regular investments in California, right? So you've got two bases, you've got, two sets of gain. It's all different. Some states will make you add the income back. Other states don't. And they don't always tell you.
And you've dealt with a lot of the different states that have these reporting obligations and investigated that and have that knowledge base.
I have for some of the states off the top of my head. Other states, I have been working for years to get clarification from them on how they want us to treat PFICs, and they won't give it to me. They can't give it to me. They don't understand them. So basically, you just have to go back and you have to look if the tax return starts with adjusted gross income. Now go to the state code section and see what the add backs are. Sometimes you will see, PFICs listed as a specific add back. Other times you don't. And then it just gives you a line that just says other stuff. I don't know. Is it other stuff? So it's not always clear. And then other states don't make you add it back. So you really be careful with the states.
Yeah, the states are always true.
Client lives in, Texas or Wyoming or one of those.
All right, last question for you. Sometimes when you do the PFIC calculations, I'm not sure if you've ever seen this, but we've seen this before where the IRS will process the form and they won't process the PFIC stuff, and they'll refund the PFIC tax that was paid with the tax return.
Absolutely.
What happens what do you tell a client when they say, well, wait a minute, I just got a huge check back for the PFIC tax that you told me I had to pay that you put on my tax return? What do you tell a client to do at that point in time?
And we see this pretty regular. It is a thing. So first of all, I'm to the point it happens often enough. I warn my clients. You may do this back. You may get a check in the mail. If you do, let me know. So I tell them you should return the check, hopefully uncashed. Don't cash it. We'll return the check to them with a letter saying, I really owe this and here's why. I've done that, and I've had the IRS, they hold the money for a few months and they refund it again.
Yeah.
Right?
Mm-hmm.
The client can also keep the check. They can cash it and put it in their account. If the IRS figures out that they have issued an erroneous refund, they will send the client a letter. The client will at that point be required to return the money. The IRS can't assess interest or any penalty until I think 20 days after they issue the letter requesting the money back. I always encourage the clients to send the money back with a letter stating why they owe it. If the IRS returns the money a second time, I'm like, put it in your bank account. Be aware if the IRS asks for it, you have to send it back.
Do you tell them, maybe put it into a savings account for 3 years, maybe the statute of limitations for assessment, and then after that, if they haven't asked for it back, it's probably likely they'll never ask for it back. Does that comport with maybe advice that you would tell a client?
Absolutely. Absolutely. I don't usually specifically suggest that it goes into a savings account, but I do usually mention don't spend it.
Yeah, that's the point, right? You got to have it if you ask for it.
This is IRS's money, and if they ask for it, you do have to send it back to them. So you want to make sure you have it ready and able to go back. But again, we've had cases where the IRS has returned the funds to them a couple of times. And at that point, it's like, I don't know what else to do.
Yeah. Well, and certainly I think at some point we need to create a support group for all the people that's happened to, so that they can all share their experiences with that and how it's all played out. Mary Beth, it's been such a pleasure talking to you. Tell our folks how they reach out to you, and we'll make sure we're gonna link all of Mary Beth's contact information and her website and all that stuff to the show notes. But tell us, someone who wanted to work with you or have expat tax tools, use a product from that. How do they find you? What's the process, all that stuff?
So generally I'm in my office, even though I've sold my tax practice. I find that I'm not very good at retirement. So I'm generally in my office every day. Mishkin will put my email up, so I'm great by email. You can also give me a call. It's 613-691-8621. You'll love that. Extension 1. You can also send a contact through our expattaxtools.com website. Those get routed over to me. And if you happen to be on the road, I'm going to be at Frank Agostino's barbecue coming up here in June up in Paramus, New Jersey. If you haven't been, that's a wonderful event.
Yes.
And we're heading over to London to work with Phil Hodgen on his event. So, I know he was a friend of the podcast. I know he's been on before, but he's awesome.
Yeah, we love Phil. I hope to have him back soon, and so happy for him and everything that he's doing over there. And so happy for you on everything that has occurred with you and your business. And if you guys run into Mary Beth, make sure you say hello to her. You'll see her at these events. And thank you so much again, Mary Beth, for coming on the podcast. We appreciate it and all of your insights on PFICs.
Well, I really appreciate you inviting me. Have a great, awesome rest of your week.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.